Are markets poised to party like it's 1999 in 2025? S&P is up more than 50% over the past 2 years, best run since the late 90s. But stocks are off to a shaky start for the first trading week of 2025. So where is the market headed from here? Joining me now, NewEdge Wealth Chief Investment Officer Cameron Dawson. Cameron, thanks for coming by. Great to see you again.
Thank you for having me.
Okay, so NewEdge has this thing where in all your reports you link it to an album or a musician or a line in a song. One possibility is 1999, but there's another possibility too. Share us your outlook.
Well, we do think 2025 will be one of the 80s greats. We think it's going to be Prince or the Talking Heads. So right. Prince, party like it's 1999, let's go crazy is the bubble scenario where markets continue to run higher. We have another year that looks like a 20% plus up year like we've had in the last two. The other scenario, and one we actually think is far more healthy, is we play the Talking Heads, meaning that we go on the road to nowhere and we sideways chop through the year. The reason that's more healthy is because it gives us time to grow into these elevated valuations, gives us time to digest the fact that positioning is extended. So it's going to be one of the two, we think. And if we get the latter, that sideways chop, it just means that you likely get some rotations and you probably get buying opportunities with that volatility.
But sentiment seems kind of frothy right now. Now, a contrarian would say, okay, that means that stocks are going to go down, but a momentum trader says, hey, it's going to do 99. You think that scenario is a little bit more likely?
Well, we do think that the sideways chop is more likely. We would see the upside bubble scenario as more of a risk, because what comes after a melt up is usually a meltdown. The reason we think that the bubble is still something that is a potential is because when you think about running high fiscal deficits and potentially running more stimulative monetary policy, usually those two things together, on top of the fact that you already have this speculative fervor that's in markets. Look what's been going on with low quality, high beta, even the crypto parts of the market. Those areas show you that people want to take risk. So if the Fed continues to cut rates a lot, it could be like throwing lighter fluid on a fire that's already burning.
Well, we've got sort of what's called a pro-cyclical monetary and fiscal policy, which is a little bit unusual if you go back in history, but instead we are throwing that lighter fluid on. You made an interesting move recently. I think in the past few days you went to value instead of growth. Is that like a quick tactical trade, or do you think that might be the way to go for 2025?
It is tactical in the moment, and we think it has to prove itself for us to stay in it for more than a month or so. The reason we decided to shift slightly more into value in those tactical buckets is because we saw value underperform by such a huge degree over the month of December. And folks like Jeff DeGraff over at BrinMac had been flagging that value performance was in the 6th percentile, meaning it doesn't get much worse than what it had been. So we thought that we were primed for some kind of snapback. For it to last more than just a few weeks, we think what we have to see is better value earnings revisions. The key reason why value has underperformed growth so relentlessly over the last 2 years is because value earnings have underperformed growth earnings. So in order to see value earnings do better, we think you need to see a weaker dollar, higher energy prices, you need to see that cyclical activity hold up, and all of those things are big show me stories. So we're in it for a short time, maybe not a long time.
Higher energy prices, there seems to be a lot of supply right now. That seems unlikely, or no?
Well, that has been the message from the oil market over the last 2 years. One of the things we don't think we can underappreciate is just how powerful falling oil prices has been, not just for the U.S. consumer, but the overall U.S. economy. It's been terrible for energy stocks. They've continued to get their earnings estimates get cut. But the fact that on a year-over-year basis, energy prices have been consistently down over the last 2 years has been a boon for consumers. This is why we think household consumption forecasts for 2024 started the year at 1.3% and ended the year at 2.7%. Huge upside surprise for the consumer. Question for 25, if oil prices do move up, could that make the consumer pull back?
Another tactical or perhaps long-term question for you. You like the middle of the market, mid-cap stocks, as opposed to the small caps and the large caps, which have done so well. Why is that?
So we have been rotating into mid-caps and favoring them over small caps. The reason that we favor mid over small is that they tend to be higher quality companies that have less debt on their balance sheet, which means that they're less sensitive to high interest rates. And one of the things about small cap caps to remember is that 40% of the Russell 2000 is unprofitable, even in this strong nominal growth environment that we've been in.
Many of them can't even make debt payments.
Well, exactly. They're the zombie companies.
Right.
And so the risk that you have with the Russell 2000 is that you've seen a huge rally on the hopes and dreams that you're going to see lower interest rates. If interest rates stay higher for longer, that's a big problem for those small cap companies.
We'll have you back to find out what they're actually doing.
Yeah.
Thanks so much, Cameron.
Thank you for having me.